When we take on debt privately, it usually sounds like a problem. But states, they constantly take on debt, often in the billions. But why is that? How exactly does it work? And can a state actually go bankrupt? In this video, you will learn why states take on debt, how this works technically, and when debt becomes dangerous, a complex issue that affects us all, whether you are a student, an employee, or an entrepreneur. So stay on it. Countries do not run up debts out of a desire to have zero in their bank accounts, but because they have to perform tasks that are very expensive and cannot be financed in the short term by taxes alone. It's about things like investment in infrastructure, like roads, bridges, railways, and digital networks, investment in education, schools, universities, and research, but also investments in healthcare systems and social security, hospitals, nursing care, medical equipment, unemployment benefits, pensions, or child benefits. In difficult economic times, e.g. during a recession, tax revenues fall because less is produced and consumed. At the same time, expenditure increases, for example through short-time working benefits or economic stimulus packages. If the state does not take countermeasures, there is a risk of mass unemployment, bankruptcies, and social instability. This is why the German debt brake, for example, deliberately allows higher levels of debt in emergency situations. The idea is therefore not to live on credit, but to intervene in the economy to stabilize it in order to prevent worse, and in the best-case scenario, to save again later. The technical process takes place in several steps and has a lot to do with trust. The state plans its budget. If the planned expenditure is higher than the expected revenue from taxes and duties, this is known as a budget deficit. To cover this deficit, the state issues government bonds. These are debt securities that are sold to investors via the stock exchange or directly via auctions. An investor, for example a bank or insurance company, buys this bond and lends money to the state. In return, the state undertakes to repay this sum after a certain term, plus interest. These bonds have terms ranging from a few months to 30 years. In Germany, for example, there are federal notes, 5 years, federal bonds, 10 to 30 years, or treasury bonds, up to 2 years. An example, you buy a 10-year federal bond with 2% interest for 1,000 euros. You receive 20 euros in interest every year, and your 1,000 euros back after 10 years. Particularly important, the state does not simply print the money for this debt itself, unless it controls its central bank directly, but is dependent on investors who are prepared to trust it. Government bonds are bought worldwide, for good reason. They are considered a low-risk investment, especially in stable countries. Typical buyers are large banks that need secure reserves, insurance companies and pension funds looking for long-term predictable income, central banks that specifically buy up bonds in order to control interest rates and the money supply, and even private individuals and foreign states. Why are government bonds so popular? They are considered reliable. A state like Germany is considered extremely solvent. They are liquid. They can be sold on at any time. They are also often tax privileged, and they help to balance out risks in a broad-based portfolio. In times of crisis, many investors flee from shares or risky investments into safe havens such as government bonds, which further increases their importance. To assess how indebted a country is, we look at the debt ratio, the ratio between total debt and gross domestic product, GDP. There is a formula for this. The national debt divided by the GDP multiplied by 100 gives the debt ratio. Example, a country has $2 trillion in debt and a GDP of $4 trillion, debt ratio, 50%. But a high ratio alone says little. The decisive factor is, how high is economic growth? How low are the interest rates on the debt? And how high is market confidence? Japan, for example, has a debt ratio of over 250%, but hardly pays any interest because it has a stable currency and a high domestic savings rate. Greece, on the other hand, was already in crisis in 2010, with a debt ratio of 130%, because the markets lacked confidence. Conclusion: it is not the absolute figure that is decisive, but whether it is sustainable. Debt is not bad per se, but it has consequences if it gets out of hand or is used incorrectly. Firstly, the interest burden. The more debt a state has, the more it has to pay in interest. These payments often weigh more heavily on the budget than investments or education spending. Secondly, loss of confidence. Investors become suspicious, demand higher interest rates, or withdraw altogether. This can lead to a spiral: more debt, higher interest rates, even more debt. Thirdly, inflation or currency devaluation. When countries start to finance their debts through the printing press, there is a threat of currency devaluation. This was the case in the Weimar Republic or in Zimbabwe, for example. And fourthly, state bankruptcy. If a state can no longer service its debts, it has to reschedule or declare that it cannot pay. The consequences are often drastic: capital flight, austerity programs, economic collapse. An example: Greece had to be bailed out by the EU in 2010. Argentina defaulted several times. Sri Lanka in 2022 could no longer raise foreign currency to pay for imports. Such crises affect not only the debtor state, but also banks, investors, trading partners, and local citizens. The question is not only how much debt, but what for. A state that takes on debt in order to invest in education, infrastructure, or digitalization can use it to stimulate future economic growth, which helps to reduce debt again in the long term. A distinction is made between consumer debt, for example, for ongoing social spending, or administration investment debt, for example, for new schools, fiber optic expansion, railroad lines, or research. The latter are considered productive because they increase economic strength and therefore help to make the debt burden sustainable. Many economists argue, especially in low-interest phases, it makes economic sense for a state to take on targeted debt, provided it flows into the state's future. The question now is, can a state really go bankrupt? The short answer: yes, but that depends on several factors. Countries with their own currency and their own central bank, such as the USA, the UK, or Japan, have a clear advantage. They can theoretically print an infinite amount of money to pay off debts. The downside: there is a risk of inflation or a loss of confidence in the currency. Countries in the Eurozone do not have this leeway. They use the euro, but the European Central Bank is independent. Countries such as Italy or Greece are therefore heavily reliant on the confidence of the markets. In the past, countries have repeatedly gone bankrupt. For example, Argentina, insolvent several times. Greece, only saved by massive aid packages. Sri Lanka, insolvent in 2022, no money for oil or medicines. A national bankruptcy not only means financial instability, but often also social and political instability. This makes a solid debt strategy all the more important. Public debt is a complex but crucial issue. Debt can be useful if it invests in the future. It can be dangerous if it destroys trust or gets out of hand. For you, this means understand where your tax money is going. Pay attention to economic connections. And inform yourself, because financial education is the first step towards greater independence. Now I'm interested in your opinion. What do you think? Should a state be allowed to incur debt to modernize schools and roads, for example? Or would you rather save and budget like a private household? Write it in the comments, give the video a like, and subscribe for more exciting economic topics. Thanks for watching, and see you next time.